I'm Rajesh Bhatia, Managing Director and CIO of ITI Long Short Equity Fund. Today, I want to talk to you about the dual challenges that an Indian investor faces. First is the challenge of making an adequate return on fixed income. If one was to invest in an FD of a bank, one is likely to make a return of 4.5% pre-tax. Compare that to an inflation rate of 5 to 6% at today's level. What that means is that one is making a negative real rate of return. In other words, one is actually losing purchasing power while investing in fixed income. This makes such investments unattractive at the moment. The second challenge is of equity markets globally and in India being at an all-time high and valuations being at extremely high peak levels. This means that there is a fear of allocating fresh money at high equity valuations. So how does one navigate such market conditions? This is a challenge not only in India, but also globally. And to address this dilemma, large and sophisticated investors are moving towards a hedge fund, specifically a long-short equity hedge fund. So what does a hedge fund or a long-short equity hedge fund actually do? While there are many variants of a hedge fund, the ITI Long-Short Equity Fund has a fundamental approach to investing, as opposed to technical-oriented, quant-oriented, or trading-oriented fund management strategies. The objective of our fund is essentially the following. In case of a market decline, protect the downside. Second, generate an equity-type return on upsides. And lastly, over a full equity market cycle, beat the equity markets, the result being achieved with much lower risk and much lower volatility for the investor. So in essence, this asymmetric return profile, which is making returns on the upside but protecting the returns on the downside, makes a hedge fund one of the best platforms to compound wealth over the long term, especially on a risk-adjusted basis. A hedge fund like ours is an asset class by itself. Basically, the potential of lowered risk of capital losses and upside opportunity to make returns in this approach. So why is this value add of protecting downside important? And does it add value to equity investing over the long term? Let me tell you, protecting downside is one of the most underestimated investment principles in India, at least today. Did you know that the first principle of Warren Buffett is rule number 1, don't lose money. Rule number 2, never forget rule number 1. I suspect he says that because of the mathematics of declines. So if you were to lose 50% on 100 rupees of capital, you're now left with 50 rupees. To return back to your principal, you need 100% return. So what becomes imperative is that in order to compound wealth at an attractive rate over the long term, are far more important to avoid losing years than having large winning years. We call it winning by not losing. Let me illustrate this with another example. In the year 2008, the Indian Nifty index lost about 55% of its value. And it took 6 years to return to its original level of where it was in 2008, which means 6 years of no return. Now, this could potentially hurt the long-term compounding rate of returns on your wealth. The need to have such an asymmetric return profile in your portfolio has never been greater. Please note, equity markets are at an all-time high in India and globally, thanks to the unleashing of large amounts of liquidity by central bankers. Moving ahead, as the debate increases on the unwinding or taking back of the extraordinary infusions of money in the system, a sharp decline or an increase in equity market volatility cannot be ruled out. Also, we expect this macro-driven equity market environment to persist for several years. So having a long-short equity fund in your portfolio becomes even more important today. I hope I've been able to add value to your investment perspective. Thank you for listening. Stay safe.